Hey guys! Welcome back to the channel. Today's video will teach you how to not lose your hard-earned cash when trading Forex. Before we jump in, make sure to head over to the description and sign up to Axie, the most trusted Forex broker in the world. They have multiple awards for being the top broker, including Best Forex MT4 Broker 2019. Now, let's get into the video. The global Forex market is the largest financial market in the world, and the potential to reap profits in the arena entices foreign exchange traders of all levels, from greenhorns just learning about financial markets to well-seasoned professionals with years of trading experience. Because access to the market is easy, with round-the-clock sessions, significant leverage, and relatively low costs, many Forex traders quickly enter the market, but then quickly exit after experiencing losses and setbacks. Here are 10 tips to help aspiring traders avoid losing money and stay in the game in the competitive world of Forex trading. Do your homework. Just because Forex is easy to get into doesn't mean due diligence should be avoided. Learning about Forex is integral to a trader's success. While the majority of trading knowledge comes from live trading and experience, a trader should learn everything about the Forex markets, including the geopolitical and economic factors that affect a trader's preferred currencies. Key takeaways. In order to avoid losing money in foreign exchange, do your homework and look for a reputable broker. Use a practice account before you go live, and be sure to keep analysis techniques to a minimum in order for them to be effective. It's important to use proper money management techniques and to start small when you go live. Control the amount of leverage and keep a trading journal. Be sure to understand the tax implications and treat your trading as a business. Homework is an ongoing effort, as traders need to be prepared to adapt to changing market conditions, regulations, and world events. Part of this research process involves developing a trading plan, a systematic method for screening and evaluating investments, determining the amount of risk that is or should be taken, and formulating short-term and long-term investment objectives. Find a reputable broker. The Forex industry has much less oversight than other markets, so it is possible to end up doing business with a less than reputable Forex broker. Due to concerns about the safety of deposits and the overall integrity of a broker, Forex traders should only open an account with a firm that is a member of the National Futures Association, NFA, and is registered with the Commodity Futures Trading Commission, CFTC, as a Futures Commission merchant. 23 Each country outside the United States has its own regulatory body with which legitimate Forex brokers should be registered. Traders should also research each broker's account offerings, including leverage amounts, commissions and spreads, initial deposits, and account funding and withdrawal policies. A helpful customer service representative should have the information and will be able to answer any questions regarding the firm's services and policies. Use a practice account. Nearly all trading platforms come with a practice account, sometimes called a simulated account or demo account, which allow traders to place hypothetical trades without a funded account. Perhaps the most important benefit of a practice account is that it allows a trader to become adept at order entry techniques. Few things are as damaging to a trading account, and a trader's confidence, as pushing the wrong button when opening or exiting a position. It is not uncommon, for example, for a new trader to accidentally add to a losing position instead of closing the trade. Multiple errors in order entry can lead to large, unprotected losing trades. Aside from the devastating financial implications, making trading mistakes is incredibly stressful. Practice makes perfect. Experiment with order entries before placing real money on the line. $5 trillion the average daily amount of trading in the global Forex market. 1. Keep charts clean. Once a Forex trader opens an account, it may be tempting to take advantage of all the technical analysis tools offered by the trading platform. While many of these indicators are well suited to the Forex markets, it is important to remember to keep analysis techniques to a minimum in order for them to be effective. Using multiples of the same types of indicators, such as 2 volatility indicators or 2 oscillators, for example, can become redundant and can even give opposing signals. This should be avoided. Any analysis technique that is not regularly used to enhance trading performance should be removed from the chart. In addition to the tools that are applied to the chart, pay attention to the overall look of the workspace. The chosen colors, fonts, and types of price bars, line, candle bar, range bar, etc., should create an easy-to-read and interpret chart, allowing the trader to respond more effectively to changing market conditions. Protect your trading account. While there is much focus on making money in Forex trading, it is important to learn how to avoid losing money. Proper money management techniques are an integral part of the process. Many veteran traders would agree that one can enter a position at any price and still make money. It's how one gets out of the trade that matters. Part of this is knowing when to accept your losses and move on. Always using a protective stop loss, a strategy designed to protect existing gains or thwart further losses by means of a stop loss order or limit order, is an effective way to make sure that losses remain reasonable. Traders can also consider using a maximum daily loss amount beyond which all positions would be closed and no new trades initiated until the next trading session. While traders should have plans to limit losses, it is equally essential to protect profits. Money management techniques such as utilizing trailing stops, a stop order that can be set at a defined percentage away from a security's current market price, can help preserve winnings while still giving a trade room to grow. Start small when going live. Once a trader has done their homework, spent time with a practice account, and has a trading plan in place, it may be time to go live, that is, start trading with real money at stake. No amount of practice trading can exactly simulate real trading. As such, it is vital to start small when going live. Factors like emotions and slippage, the difference between the expected price of a trade and the price at which the trade is actually executed, cannot be fully understood and accounted for until trading live. Additionally, a trading plan that performed like a champ in backtesting results or practice trading could, in reality, fail miserably when applied to a live market. By starting small, a trader can evaluate their trading plan and emotions, and gain more practice in executing precise order entries, without risking the entire trading account in the process. Use reasonable leverage. Forex trading is unique in the amount of leverage that is afforded to its participants. One reason Forex appeals to active traders is the opportunity to make potentially large profits with a very small investment, sometimes as little as $50. Properly used, leverage does provide the potential for growth. But leverage can just as easily amplify losses. A trader can control the amount of leverage used by basing position size on the account balance. For example, if a trader has $10,000 in a Forex account, a $100,000 position, one standard lot, would utilize 10-to-1 leverage. While the trader could open a much larger position if they were to maximize leverage, a smaller position will limit risk. Keep good records. A trading journal is an effective way to learn from both losses and successes in Forex trading. Keeping a record of trading activity containing dates, instruments, profits, losses, and, perhaps most important, the trader's own performance and emotions can be incredibly beneficial to growing as a successful trader. When periodically reviewed, a trading journal provides important feedback that makes learning possible. Einstein once said that, insanity is doing the same thing over and over and expecting different results. For without a trading journal and good record keeping, traders are likely to continue making the same mistakes, minimizing their chances of becoming profitable and successful traders. No tax impact and treatment. It is important to understand the tax implications and treatment of Forex trading activity in order to be prepared at tax time. Consulting with a qualified accountant or tax specialist can help avoid any surprises and can help individuals take advantage of various tax laws, such as mark-to-market accounting, recording the value of an asset to reflect its current market levels. Treat trading as a business. It is essential to treat Forex trading as a business and to remember that individual wins and losses don't matter in the short run. It is how the trading business performs over time that is important. As such, traders should try to avoid becoming overly emotional about either wins or losses, and treat each as just another day at the office. As with any business, Forex trading incurs expenses, losses, taxes, risk and uncertainty. Also, just as small businesses rarely become successful overnight, neither do most Forex traders. Planning, setting realistic goals, staying organized, and learning from both successes and failures will help ensure a long, successful career as a Forex trader. The bottom line. The worldwide Forex market is attractive to many traders because of the low account requirements, round-the-clock trading, and access to high amounts of leverage. When approached as a business, Forex trading can be profitable and rewarding, but reaching a level of success is extremely challenging and can take a long time. Traders can improve their odds by taking steps to avoid losses, doing research, not over-leveraging positions, using sound money management techniques, and approaching Forex trading as a business. How leverage works in the Forex market. Leverage is the use of borrowed money, called capital, to invest in a currency, stock, or security. The concept of leverage is very common in Forex trading. By borrowing money from a broker, investors can trade larger positions in a currency. As a result, leverage magnifies the returns from favorable movements in a currency's exchange rate. However, leverage is a double-edged sword, meaning it can also magnify losses. It's important that Forex traders learn how to manage leverage and employ risk management strategies to mitigate Forex losses. Key takeaways. Leverage, which is the use of borrowed money to invest, is very common in Forex trading. By borrowing money from a broker, investors can trade larger positions in a currency. However, leverage is a double-edged sword, meaning it can also magnify losses. Many brokers require a percentage of a trade to be held in cash as collateral, and that requirement can be higher for certain currencies. Understanding leverage in the Forex market. The Forex market is the largest in the world with more than $5 trillion worth of currency exchanges occurring daily. Forex trading involves buying and selling the exchange rates of currencies with the goal that the rate will move in the trader's favor. Forex currency rates are quoted or shown as bid and ask prices with the broker. If an investor wants to go long or buy a currency, they would be quoted the ask price, and when they want to sell the currency, they would be quoted the bid price. For example, an investor might buy the euro versus the US dollar, EUR, USD, with the hope that the exchange rate will rise. The trader would buy the EUR, USD at the ask price of $1.10. Assuming the rate moved favorably, the trader would unwind the position a few hours later by selling the same amount of EUR, USD back to the broker using the bid price. The difference between the buy and sell exchange rates would represent the gain, or loss, on the trade. Investors use leverage to enhance the profit from Forex trading. The Forex market offers one of the highest amounts of leverage available to investors. Leverage is essentially a loan that is provided to an investor from the broker. The trader's Forex account is established to allow trading on margin or borrowed funds. Some brokers may limit the amount of leverage used initially with new traders. In most cases, traders can tailor the amount or size of the trade based on the leverage that they desire. However, the broker will require a percentage of the trade's notional amount to be held in the account as cash, which is called the initial margin. Types of leverage ratios. The initial margin required by each broker can vary, depending on the size of the trade. If an investor buys $100,000 worth of EUR, USD, they might be required to hold $1,000 in the account as margin. In other words, the margin requirement would be 1% or $1,000 per $100,000. The leverage ratio shows how much the trade size is magnified as a result of the margin held by the broker. Using the initial margin example above, the leverage ratio for the trade would equal 100 to 1, $100,000 per $1,000. In other words, for a $1,000 deposit, an investor can trade $100,000 in a particular currency pair. The lower the margin requirement, the greater amount of leverage can be used on each trade. However, a broker may require higher margin requirements, depending on the particular currency being traded. For example, the exchange rate for the British pound versus Japanese yen can be quite volatile, meaning it can fluctuate wildly, leading to large swings in the rate. A broker may want more money held as collateral, i.e. 5%, for more volatile currencies and during volatile trading periods. Forex leverage and trade size. A broker can require different margin requirements for larger trades versus smaller trades. As outlined in the table above, a 100 to 1 ratio means that the trader is required to have at least 1/100th equals 1% of the total value of the trade as collateral in the trading account. Standard trading is done on 100,000 units of currency, so for a trade of this size, the leverage provided might be 50 to 1 or 100 to 1. A higher leverage ratio, such as 200 to 1, is usually used for positions of $50,000 or less. Many brokers allow investors to execute smaller trades, such as $10,000 to $50,000 in which the margin might be lower. However, a new account probably won't qualify for 200 to 1 leverage. It's fairly common for a broker to allow 50 to 1 leverage for a $50,000 trade. A 50 to 1 leverage ratio means that the minimum margin requirement for the trader is 1/50th equals 2%. So, a $50,000 trade would require $1,000 as collateral. Please bear in mind that the margin requirement is going to fluctuate, depending on the leverage used for that currency and what the broker requires. Some brokers require a 10 to 15% margin requirement for emerging market currencies such as the Mexican peso. However, the leverage allowed might only be 20 to 1, despite the increased amount of collateral. Forex brokers have to manage their risk and in doing so, may increase a trader's margin requirement or reduce the leverage ratio and ultimately, the position size. Leverage in the Forex markets tends to be significantly larger than the 2-to-1 leverage commonly provided on equities and the 15-to-1 leverage provided in the futures market. Although 100-to-1 leverage may seem extremely risky, the risk is significantly less when you consider that currency prices usually change by less than 1% during intraday trading within one day. If currencies fluctuated as much as equities, brokers would not be able to provide as much leverage. The risks of leverage. Although the ability to earn significant profits by using leverage is substantial, leverage can also work against investors. For example, if the currency underlying one of your trades moves in the opposite direction of what you believed would happen, leverage will greatly amplify the potential losses. To avoid a catastrophe, Forex traders usually implement a strict trading style that includes the use of stop-loss orders to control potential losses. A stop-loss is a trade order with the broker to exit a position at a certain price level. In this way, a trader can cap the losses on a trade. How do you make money trading currencies? Investors can trade almost any currency in the world through foreign exchange, Forex. In order to make money in Forex, you should be aware that you are taking on a speculative risk. In essence, you are betting that the value of one currency will increase relative to another. The expected return of currency trading is similar to the money market and lower than stocks or bonds. However, it is possible to increase both returns and risk by using leverage. Currency trading is generally more profitable for active traders than passive investors. Key takeaways. It is possible to make money trading money when the prices of foreign currencies rise and fall. Currencies are traded in pairs. Buying and selling currency can be very profitable for active traders because of low trading costs, diverse markets, and the availability of high leverage. Exchanging currency is not a good way for passive investors to make money. It is easy to get started trading money at many large brokerages and specialized Forex brokers. Buying and selling currency explained. It is important to note that currencies are traded and priced in pairs. For example, you may have seen a currency quote for a EUR/USD pair of 1.1256. In this example, the base currency is the euro. The US dollar is the quote currency. In all currency quote cases, the base currency is worth 1 unit. The quoted currency is the amount of currency that 1 unit of the base currency can buy. Based on our previous example, all that means is that 1 euro can buy 1.1256 US dollars. An investor can make money in Forex by appreciation in the value of the quoted currency or by a decrease in value of the base currency. Another perspective on currency trading comes from considering the position an investor is taking on each currency pair. The base currency can be thought of as a short position because you are selling the base currency to purchase the quoted currency. In turn, the quoted currency can be seen as a long position on the currency pair. In our example above, we see that 1 euro can purchase $1.1256 and vice versa. To buy the euros, the investor must first go short on the US dollar to go long on the euro. To make money on this investment, the investor will have to sell back the euros when their value appreciates relative to the US dollar. For instance, let's assume the value of the euro appreciates to $1.1266. On a lot of 100,000 euros, the investor would gain $100, $112,660 to $112,560, if they sold the euros at this exchange rate. Conversely, if the EUR/USD exchange rate fell from $1.1256 to $1.1246, then the investor would lose $100, $112,460 to $112,560. Advantages for active traders. The currency market is a paradise for active traders. The Forex market is the most liquid market in the world. Commissions are often zero, and bid-ask spreads are near zero. Spreads near 1 pip are common for some currency pairs. It is possible to frequently trade Forex without high transaction costs. With Forex, there is always a bull market somewhere. The long-short nature of Forex, the diversity of global currencies, and the low or even negative correlation of many currencies with stock markets ensures constant opportunities to trade. There is no need to sit on the sidelines for years during bear markets. Although Forex has a reputation as risky, it is actually an ideal place to get started with active trading. Currencies are generally less volatile than stocks, as long as you don't use leverage. The low returns for passive investment in the Forex market also make it much harder to confuse a bull market with being a financial genius. If you can make money in the Forex market, you can make it anywhere. Finally, the Forex market offers access to much higher levels of leverage for experienced traders. Regulation T sharply limits the maximum leverage available to stock investors in the United States. 1. It is usually possible to get 50-to-1 leverage in the Forex market, and it is sometimes possible to get 400-to-1 leverage. This high leverage is one of the reasons for the risky reputation of currency trading. New Forex traders should not use high leverage. It is best to start using little or no leverage and gradually increase it as profits and experience grow. Disadvantages for passive investors. Passive investors seldom make money in the Forex market. The first reason is that returns to passively holding foreign currencies are low, similar to the money market. If you think about it, that makes sense. When US investors buy euros in the Forex market, they are really investing in the EU's money market. Money markets around the world generally have low expected returns, and so does Forex. The benefits of the Forex market for active traders are usually useless or even harmful for passive investors. Low trading costs mean very little if you do not trade very much. Using high leverage without a stop-loss order can lead to large losses. On the other hand, using stop-loss orders essentially turns an investor into an active trader. Getting started with Forex. The Forex market was once much less accessible to average investors, but getting started is easy now. Many large brokerages, such as Fidelity, offer Forex trading to their customers. Specialized Forex brokers, such as Oanda, make sophisticated tools available to traders with balances as low as $1.